Thanks. My name's Alex Kaplan. I'm with a group called Amwins. You would never have heard of it unless you work in insurance. We're actually the largest wholesale distributor of insurance globally. And so I've got some industry colleagues here with me. I'll allow them to introduce themselves, but we're going to talk about, obviously, the industry as a whole, where it stands today, where it's going, some of the issues that we see, not only relating to climate change, but just in terms of societal structural issues that lead to increased risk. I mean, it's obviously not a secret to anyone. You may have seen, you see NOAA puts out a chart of billion-dollar disasters every year, and this year, 2023, we're at $25 billion weather disasters in the United States, and that breaks the record by 3 events from 2020. And I would pose that we're not going back to a lower level, simply because of the massive accumulation of wealth and assets in the most disaster-prone areas around the country. So let me pause there for a second and allow my colleagues here, Dave and Tony, to introduce themselves real quickly.
Great. I'm Dave Jones. I'm a recovering insurance regulator. I served for 8 years as California's insurance commissioner, and now I'm at UC Berkeley School of Law's Center for Law, Energy, and the Environment. We're a forward-looking think tank that develops policy to address aspects of climate change as well as broader environmental issues, and I focus on an initiative around climate risk and the financial sector. What should financial institutions like banks and insurance companies be doing vis-a-vis the impacts of climate change, and what should financial regulators be doing as well?
Thank you, Tony Kaczynski. I like that phrase. I'm going to be a recovering insurance reinsurance executive. I was actually I've been in the industry for close to 40 years, 34 years with Munich Reinsurance. Munich Re is a global reinsurer and specialty insurer, probably the largest reinsurer in the world, takes on some of the biggest risks in the world. I was 15 years as the Munich Re U.S. and North American CEO for both the reinsurance side and the insurance side. So I've seen this exposure up front and personal. I know exactly what it can do and what it does do. I can also tell you Munich Re is a company, and I'm not speaking, by the way, on behalf of Munich Re, although I've learned an awful lot from them. I'm here as Tony with experience in the industry because I want to have the freedom of saying what I think needs to be said if the opportunity presents itself. But I will tell you, Munich Re has been in the climate change business for more than 50 years. We have been one of the first to develop some of the mapping, some of the exposures, some of the learnings and knowledge sharing. But I will say it wasn't until about maybe 15 plus years ago where it really started to take hold just about everywhere. So we do have a lot of experience in this place, as you would expect as a reinsurance company and with insurance companies as part of the portfolio. We take substantial risk, so we know what it is. At least we try to know what it is we're taking on, and we also know when the marketplace is or is not cooperating with us. So it'll be great to have that discussion.
Yeah, thank you both. So obviously a wealth of knowledge up here. I don't know how many of you read insurance industry trade press as religiously as I do. I mean, Duke, I know Duke does. No. But you probably have heard a little bit about insurance this year, more so than other years. The insurance market as a whole on a global basis is quite cyclical, and we were in a period, what we refer to as a soft market, for quite a period of time where prices were coming down, there was ample capital in the market to take on risk, and then over the last, let's say, 24, 36 months, we've entered into what we refer to as a hard market. And this is the hardest market, I think, at least 31 years since Hurricane Andrew, maybe longer than that, right, where capital has pulled back and underwriting standards have brought in more rigor. And as a result, we see prices going up all across the country. Doesn't matter what peril, what exposure you have, what state you're in, all of you likely have experienced increased rates on your homeowner's insurance, on your business lines of coverage, whether that be in the property side or in the casualty side, thinking liability and other places like this. And so maybe I'll go first to Tony. Just maybe give us a little bit of the landscape, like where are we as a market and how did we get here?
So I agree with everything you just said. We're in what we call it hard and soft markets. That's how we differentiate between whether it's pricing flexibility or on the part of the insurer or reinsurer, or is it on behalf of the buyer of the product? Hard market means that it's harder to find, it will cost more money, and insurers and reinsurers watch very carefully the exposures they're putting out. And I would agree, this is probably the longest lived hard market I have ever seen, and I've been through at least 3 or 4 of them. And it's not finished yet, and it probably started a good 3+ years ago, 4 years ago, mostly on the property side, mostly on the big risk side, mostly on those exposures that are subject to some of the things we've been talking about all day. It is my expectation we will continue to see a hard, or I'll call it a firm market in 2024, maybe 2025. Firm meaning even if it doesn't go any further north in terms of pricing or underwriting standards, it will in fact hold the line. Capital, you use the term capital. Capital is probably as big as it's been in the industry in a long time, but in our business, you could lose capital really, really quickly. So having a healthy balance sheet, and by the way, we do this for profit, but we also, we are expected.
By the way, which is a good thing.
Yes,
you do not want to have your insurance with an unprofitable insurance company.
And I hope we get into this discussion. I think part of the issue that we should be talking about at some point in time is that concept of how much money do insurers really make or not make, and really why it could drive the behaviors on the topic of climate. But in any event, we're in a very, very strong marketplace. I expect it'll stay this way for at least another year or two. And when we talk market, it's a big market. It's property, it's casualty, it's health, it's, I don't mean all parts of the market are all firm or all hard at the same time, but the property space for sure, and I'll call it the third party casualty and professional lines business for sure are in that stage.
So I have a slightly more pessimistic view. And so I began to see, say, in 2013, 2014, as California's insurance regulator, regulating the largest insurance market in the United States and about the 5th largest in the world, that direct writers of home insurance were beginning to non-renew on a selective basis homes in the wildland-urban interface, typically forested areas of California, but also chaparral and other areas adjacent to or within wildlands. And they were increasingly using more sophisticated, but not completely sophisticated risk score models. Now, you should understand that when an insurance company makes a decision whether to renew your home insurance or write new home insurance, they have unfettered discretion in doing so. They are increasingly using risk score models that look at the particular home and its exposure to risk, and also increasingly what mitigation measures the homeowner might be taking, which is a positive thing. But they have complete latitude as to their appetite for risk. And we began to see more and more homes in high wildfire risk areas be non-renewed. That really accelerated after the 2017 and 2018 wildfires in California, where insurers collectively lost one year about $12 billion and the second year about $15 billion in payouts associated with losses from wildfire. California is not unique in this regard. I mean, you can look across the 10, and you're seeing in all jurisdictions where climate change impacts are landing, in the Gulf Coast, Florida, Mississippi, Alabama, Louisiana. Increased insurance pricing, which is one way that insurance companies respond to more losses. They'll increase price. There's some regulatory hurdles they have to go through. Those vary by state. But the other option they have is not to write the insurance. And so in Florida, for example, their wind insurer of last resort, which is Florida Citizens, now has 1.3 million policyholders. Why? Because those are 1.3 million homeowners who either can't find or can't afford private home insurance in Florida. In California, our FAIR Plan, which is the writer of last resort for wildfire insurance, Their policy count has gone up. It's not as bad as Florida. It's about 400,000 now. That's about 4% of our overall market. And so I believe that one of the contributors to this phenomenon is climate change. It's causing more frequent and severe weather-related events. That's killing people, destroying property, and causing higher insurance losses. And we're not doing enough to knock down greenhouse gas emissions and to wean ourselves from the burning of fossil fuels fast enough. And so, temperatures are on track to rise maybe 3 degrees Celsius, maybe more. And so I think a lot of this is already baked into the weather and climate system. It's only going to get worse. And I do think in some geographies, based on the acuity of the impact, we're marching into an uninsurable future as it relates to some home and property insurance. Now, it's not everywhere, and it varies considerably, and there's some policy and regulatory changes you can do around the edges to make things better. But I'm more pessimistic with regard to what the underlying risk driver is here, which is climate change and its impact on the viability of private insurance in some parts of the United States.
I like where this is going, because we have the regulator, recovering regulator, and the regulated.
This is going to make it a very, very rich
Tony.
Discussion. At least I hope so. So you don't mind, do I? Do you? So I fully agree. I agree with the pessimism, but there's no question the insurer's view of risk has grown dramatically, especially on the property side, especially where climate is a factor. There is no doubt we are in 100% alignment there. I think some of the industry is coming along a little bit, taking a little bit longer to get there, but many of us have been there for a long time. But we also operate in a regulated environment. And as much as we can price, and not as a reinsurer, I'm a much less regulated entity as a reinsurer than I am as an insurer. But if I'm an insurer that's not, where my business is not driven by the non-admitted marketplace, I do have very stringent rules that I operate within from a pricing and from a actually being in the marketplace perspective. And in both cases, we mentioned where there's some pretty big withdrawal. It's not just climate change. It's the, I'll say it from an insurer's perspective, rather unfriendly regulatory environment that's forcing those companies to make those decisions. Not because they're afraid of the risk, but they have limited control over the risk that they're taking on. For example, if you might be able to pick and choose your risks within California, but you can't withdraw from California. You have to give, or you have to put a moratorium in place to say, I'm going to hold on, or a moratorium would be put in place to force you to stay on the risk for a period of time when you know the risk is not priced appropriately. In the very different issue in the state of Florida, the Florida issue was much more around legal system abuse. I know there's a lot of lawyers in the room, but there was a process going on where everything got inflated. You thought you were insuring X, and because of legal system abuse and the way that works, every price went up because you wanted to avoid litigation, because if you're going to go to litigation, it was going to cost you even more. So it's not just the environment. We want to take risk as an insurance industry, and I'll stand behind the industry in terms of taking its appropriate share of risk, responding to that risk, and I think doing so as good as anybody can do. But it's also about a level playing field to make sure you can do what's right. And I think we'll probably talk to federal and state and all that kind of stuff.
Well, yeah, right. I mean, so we obviously touched on the climate element. You kind of briefly touched on lawsuits. I mean, a not so fun fact, Florida is responsible for 9% of all property claims and 80% of all litigation. So you have a lot of markets that are simply saying, like, this is not an environment I want to operate in, so I'm going to pull out. And you have it in Louisiana, you have it in California as well, with markets just saying, like, it's either we can't charge an adequate rate, or frankly, we don't have a good understanding of the risk, right? We all operate with risk models, right? And there's some independent third-party vendor models that every market uses. And there's even some relatively new wildfire models. And I think the sad truth is that all models are necessary, and they're all completely wrong, right? And so there's this assumption that, we're able to charge a risk-appropriate rate, and you have issues like social inflation, litigation, assignment of benefits in Florida, and a whole host of other factors that are leading to these outsized claims payments, right? I mean, anecdotally, I'll tell you one story of a client that had a $50 million building. It was insured for $50 million. That's how it was underwritten. That's how it was charged. Gets destroyed by a tornado, and it has to be rebuilt for $125 million, right? And so the insurance company's like, whoa, whoa. So everybody questions, everything is undervalued. So if you think about the social inflationary elements that are driving up the risk itself is changing marginally, but the value of things is changing so dramatically that it's completely flipping over the risk profile of particular risks.
So let me challenge some of that. I mean, yes, climate change is driving this. Yes, putting more people and businesses into areas impacted by climate change is driving these losses, and increased values at risk are driving them as well. But on regulation, I mean, I think that the jury is out with regard to whether modifying regulation is going to solve this problem. Okay, so Florida has allowed probabilistic forward-looking models for pricing. They've allowed reinsurance costs to be included in rates for decades. They created a reinsurance, sort of a public option for reinsurance after Hurricane Andrew. They created another one recently. Their rates are 3 or 4 times the national average. They passed legislation that DeSantis signed in December that eliminates one-way attorney's fees, caps the ability of assignment of benefits. They've made tremendous reductions in regulation. They don't have prior approval for rates. They have file and use, so the insurance company sets its rate, files it, and then waits to see if the regulator is going to complain about it. Despite all that, 2 months ago, Farmers, one of the nation's biggest insurers, despite all that, and despite the limitation on the ability to do lawsuits, assign benefits, or attorney's fees in Florida, now Farmers announced not only were they not going to be writing new insurance in Florida, they're not renewing any home, any auto, any umbrella policies. They're leaving the market entirely, and they're one of 5 carriers that have said that. So maybe I think the jury's still out on the regulatory changes in Florida. Will they work sufficiently? Maybe at the margins they will. Maybe they'll encourage more private carriers to come back in. Maybe there'll be a chance to depopulate Florida citizens, maybe. But my view is that, and we could do all those things in California potentially too, right? But they may be overwhelmed by the underlying risk driver, which is climate change. So let me just touch on one last thing on models.
Fully agree.
One last thing on models. So, I mean, I think the industry is fantastic in terms of cat modeling and what they bring to bear. But in some ways, those models don't go far enough, particularly the models the direct writers are using to decide whether to insure your home or not. And I'll give you one example, and then I'll stop. So in California, our governor and legislature have decided to appropriate $2.7 billion for forest treatment, prescribed fire and thinning forests. Our forests are choked with fuel. That's what's contributing to some of the severity of losses. The infrastructure bill is about $5 billion to be spent nationwide for treatment of national lands. Homeowners associations, local governments, regional governments putting money in forest treatment. Guess what? The models that the insurers use to decide whether to renew or write your home insurance in California do not account for forest treatment. Right. So I think there are some, I mean, it's not all bad news, right? There are some mitigation strategies that will reduce the risk, notwithstanding the risk being driven by climate change. We do need to get the insurers to take those up in their modeling and then begin to write insurance accordingly.
Fully agree. I think we're fully aligned. I'm not suggesting at all that it's one size fits all or it's one issue. And modeling is one of those things. And it's about predicting a future, though. It's about predicting a future based upon actions that might have taken. So sometimes these things just take a little bit of time for everybody to get comfortable in saying, okay, my view of the risk has now changed in a positive way. I can re-enter the market. I don't know the reason for every single company moving from a market, but it's more than one. So there's something more than just that company's concern about risk. It's just multiple. That's what makes markets move, though. At the end of the day, they will be back if there's a comfort level that they could assess the risk, they could price for the risk, and they could be relatively free to do what they need to do to write the risk.
Yeah. So without a doubt, the insurance industry has a role. It is imperfect. It has some work to do, certainly with respect to risk modeling, but then also translating that into their rating structures, right? Because at the end of the day, right, I've looked at thousands of accounts in the last 3 or 4 years, the variance in the quality of the data that goes into the information that you're getting to underwrite an account is dramatic. And when you take that data and you put it into a model, if the information is incomplete, the model will always assume the worst. So the data has to be complete and it has to be accurate. So when I think about this issue more broadly about sustainability and resilience and the challenges or the structural challenges that we have to address these issues, I kind of break it into two categories, and maybe I'm oversimplifying it, right? But one is risk perception, right? Generally, as human beings, we underestimate what we're exposed to and make judgments because we like to live in, rose-colored glasses type of thing, right? And the second piece is risk ownership. The assumption that if something bad happens, some other entity is going to come in and make us whole, right? Individuals, counties, cities look to the state looks to the federal government. In the 1980s, FEMA issued a disaster declaration on average every 16 days. In 2020, FEMA issued a disaster declaration every 26 hours. How on earth is that sustainable? And if the assertion is that the federal government will be the backstop, states and counties and cities get to make determinations over development strategies, investment strategies, land use planning, et cetera, and then the bad thing happens and they just turn and pass the bill off to the federal government. So let's play a game. What if the federal government didn't exist in this context? How would we as states, as the 10 corridor, as an industry, respond believing that there wasn't this backstop of the federal government, right? Because most of those dollars go back to building exactly the way it always was, right? We talk about build back better, but does that really happen? I mean, anecdotally, I know there's a story of an individual who had a home insured by the NFIP. The NFIP rebuilt that house the exact same place in the exact same way 16 times, right? So what can the industry do? What can states do to manage, understand, appreciate, communicate that risk, or even so transfer that risk off the back of their taxpayers, off the back of their citizens, into a willing insurance market?
There's a lot to unpack there. Okay, so let me start with your counterfactual about, FEMA didn't exist. First, I think it's important to note, other than the National Flood Insurance Program, which is a great example, and look, I love the private insurance sector. I want there to be more private insurance. It's not a good thing that I'm worried that in some parts of the United States it won't be available. But 50 or 60 years ago, the Directors of Home Insurance decided flood insurance was too risky, they couldn't make money on it, and they stopped writing it. Here's what not to do, which is what we did. Congress ran to the rescue and created the National Flood Insurance Program. Didn't require it to be risk adjusted. As a result, every 10 or 15 years, because it's paying out so much money because we keep rebuilding homes in areas that keep flooding, Congress has to put $10 or $15 billion on it, passes a law that says, hey, it should be risk adjusted. FEMA goes out and starts to raise the flood insurance rates. People go nuts. And then Congress says, oh, I wanted it risk adjusted, but I didn't mean the price should go up.
Okay, so let me
but putting that aside, so here's what not to do, I think. Don't create a national scheme of insurance, because that doesn't go very well, I think. But what we have right now are state fair plans in 35 or 36 states that are basically involuntary associations of insurers writing in that state who write the risks that the private insurers won't write. I think you shore those up to the extent that private insurance is not available. But FEMA generally won't rebuild your home if you don't have insurance. They may do the infrastructure for the city or county that's burned. I'm not convinced that it's the existence of FEMA that's the problem. I think it's that states have delegated land use decisions, with all due respect to my friends and colleagues from local government who are here, who are terrific. But states have delegated land use decisions to cities and counties that are facing inordinate pressures to continue to build in areas where there's high risk. So we're throwing more people and businesses into harm's way, even though the private insurance industry is throwing up the flag saying, hey, we can't insure this, some of it, you know? And so to expect the private insurance industry to solve that problem, I think, is maybe asking too much for them to do.
Well, I think that's an important point, right? I mean, it feels like the insurance industry is always brought in at the tail end of a conversation, right? It's like, okay, we're going to designate this land for X, Y, and Z. Developer comes in, makes proposals, it gets approved. They go through the process of bidding, et cetera, and then at the end of the process, before they start construction, they're like, let's look for insurance. And I can't tell you how many deals I worked on this year, like large solar projects that were completely put together with all the tax equity partners that fell apart at the last minute because they're like, wow, the insurance is so expensive because we didn't talk about what types of panels to put in or what angle to set them, what kind of slope to set them at the end, and the deal died. And those projects are not being completed.
So just to add on to the commentary, there's no question, I agree completely. We have a misalignment or misallocation to a certain extent. We have federal government as a government of a insurer of last resort, let's call it. We have state and we have local. Locals where most planning decisions, most day-to-day business decisions or decisions are made for their communities. And I don't think anybody's giving the foresight to what happens if. Insurance industry's in the risk business, so when we take on a risk at the front end, that's what we do. We try to think about that. We don't always get it right, but we try to think about it and say, okay, is it insurable? Is the spread of risk enough so that I can collect enough money from the various parties? Because if you can't get enough money from the various parties, because you don't know who's going to call the insurance. You do know in a big event, lots of people will call, but you don't know exactly who's going to call. So you have to have a mechanism in place that says, these are the risk characteristics, and here's what we need to price if we're going to participate in this space. But if the government, if the insurer of last resort doesn't go there and doesn't risk price the risk, and they know, by the way, I have visited the White House many times in my various roles over the year in the insurance business. FEMA knows what happens. FEMA knows that they're going to be really tough. We're not going to let the state come and just call us for support or let the local community call us for support. And sure enough, that event happens, and guess what happens? They open up the pocketbook. And yet we didn't start with the first premise, and I think this gets to where you started. What was the risk in the first place you were trying to protect? And why didn't we cover it? I don't have the exact numbers, and this is old, but I did a study a long time ago. It's about 5 times more to pay for the event post-event than if we spent the time and energy and money before the event. Correct. If we said, wait a minute, that is an exposed area. It needs to be resilient in nature. Yes, let's deal with adaptation and mitigation, but if we can build with some resiliency, we can get a different risk outcome. But we don't do it. We wait for the moment for it to happen, and I think it's political. It's about who loses a seat or who has the gumption to take on this challenge, but that's part of the issue. As an insurer that has a responsibility to return on its capital, we can't take that position. We have to take the position we can write where we think we can produce the return. And we'll lose money in many years, as long as over a 5-year period or 7-year period, we can see some light that we can make money on that return. So I think I think the short answer to your question is, if the federal government was there, I think we'd be forced. If there was no insurer of last resort there, we'd be forced at the front end to think differently.